two Nobel Prize winners. The former vice chairman of the Federal Reserve. The most celebrated bond trader of his generation. $1 trillion in market exposure. Then they lost $4.6 billion in 5 weeks. And the Federal Reserve had to save the world from them. This is long-term capital management. They had two Nobel Prize winners on the team. They had the former vice chairman of the Federal Reserve. They had the most celebrated bond trader of his generation. They had mathematical models so sophisticated that virtually nobody outside the fund fully understood them. And in 1998, with $125 billion in assets and $1 trillion in derivatives exposure, they lost $4.6 billion in 5 weeks, and the Federal Reserve had to organize a private sector bailout to prevent them from bringing down the entire global financial system. This is long-term capital management. And it is the story of what happens when the smartest people in the room forget that markets are not equations. John Meriwether was born in Chicago in 1947, and he became one of the most celebrated bond traders on Wall Street, building the legendary fixed-income arbitrage desk at Salomon Brothers into one of the most profitable operations in banking history, and he was known for his ability to identify tiny pricing discrepancies in bond markets and exploit them systematically and profitably. And in 1994, after leaving Salomon Brothers following an internal trading scandal, he founded Long-Term Capital Management in Greenwich, Connecticut, and what he built was unlike anything the financial world had seen before. The founding team was extraordinary by any measure, and it included Myron and Robert Merton, two economists who would share the Nobel Prize in Economics in 1997, the very year before the collapse, for their work on options pricing theory. And it included David Mullins, who had been vice chairman of the Federal Reserve, and it included some of the most talented quantitative analysts in the world, and together they built a fund based on a single powerful idea that bond markets contained systematic pricing anomalies that could be identified and exploited through mathematical models, that similar bonds which should trade at similar prices would occasionally diverge, and that this divergence would eventually correct, and that if you identified these divergences and bet on their convergence, you would make money reliably and repeatedly. And for 4 years they were right, and the returns were extraordinary: 43% in 1995, 41% in 1996, 27% in 1997, and the financial world could not give them money fast enough. Banks competed to lend to LTCM. Investors competed to invest. And the fund grew, and with the growth came leverage and more leverage and more leverage still, until by 1998 LTCM had approximately $125 billion in assets built on a capital base of only about $4.7 billion, and it had derivative positions totaling approximately $1 trillion. $1 trillion, and the leverage ratio was extraordinary, roughly 25-to-1 on its balance sheet, and far higher when derivatives were included, meaning that a relatively small adverse movement in markets could wipe out the entire capital base. Then in August 1998 Russia defaulted on its government debt, and this was unexpected and it was significant, and what it triggered was a global flight to safety. Investors around the world simultaneously rushed to sell risky assets and buy the safest, most liquid government bonds, and this flight to safety caused exactly the opposite of what LTCM's models predicted. Instead of the pricing anomalies LTCM had bet on converging, they diverged, wildly, simultaneously, across every market in which LTCM operated. The models had assumed that different markets would not all move in the same direction at the same time, but in a crisis they did. They always do, and LTCM began losing money at a speed that was almost incomprehensible: $500 million on a single day, billions in a single week. And as the losses mounted, the banks that had lent to LTCM began demanding their money back, and to meet those demands LTCM was forced to sell positions, and the selling made prices move further against it, and the losses accelerated in a catastrophic spiral. By September 1998 LTCM had lost $4.6 billion, almost its entire capital base, and the Federal Reserve Bank of New York became alarmed, not because of the losses themselves, but because of the size and interconnectedness of LTCM's positions. Because if LTCM was forced into a disorderly liquidation, forced to sell $1 trillion of derivative positions into panicked markets, the resulting chaos could damage every major financial institution in the world. Simultaneously, and on September 23, 1998, the Federal Reserve Bank of New York convened an emergency meeting of the major Wall Street banks and investment firms, and they agreed to inject $3.6 billion into LTCM in exchange for 90% of the fund, and the partners who had built the fund were left with 10% of something that had once made them all extraordinarily wealthy, and the fund was slowly wound down over the following months. The bailout was controversial, and it raised profound questions. Questions that financial regulators and economists are still debating today, because LTCM was not a bank, it had no depositors, it had no government guarantee, It was a private hedge fund for sophisticated investors. And yet the Federal Reserve had effectively organized its rescue, not to protect investors who had made a choice to invest, but to protect the financial system itself from the consequences of a disorderly collapse. And the question this raised was fundamental. If a private hedge fund can become so large and so interconnected that its failure would threaten the entire financial system, then what is the appropriate regulatory response and who is responsible for preventing it? John Meriwether went on to found another fund, JWM Associates, which also experienced significant losses during the financial crisis of 2008 and was wound down, and then another fund after that, suggesting that the lessons of LTCM were absorbed by everyone except perhaps the man who had built it. So what is the real lesson of long-term capital management? And the lesson has several layers, and the first layer is about the limits of mathematical models. Models are built on assumptions, and the most dangerous assumption in any financial model is the assumption that the future will resemble the past, that correlations observed in normal markets will hold in crisis markets, that the distributions of returns follow the patterns that historical data suggests. In 1998, the Russian default triggered a once-in-a-lifetime flight to safety that broke every assumption LTCM's models had been built on, and the models had no mechanism for imagining a world in which everything went wrong simultaneously. The second layer is about leverage. LTCM's models were almost certainly right in direction. The pricing anomalies they identified probably would have corrected, eventually, but with 25-to-1 leverage there was no ability to wait for eventually. The losses came faster than the correction and the fund was destroyed before it could be vindicated. The third layer is about systemic risk. LTCM demonstrated for the first time in modern finance that a private institution, with no retail depositors and no government backing, could become so large and so interconnected that its failure would threaten the entire system. And this insight, which regulators failed to fully absorb before 2008, is at the heart of every subsequent financial crisis. That is the capital case. Subscribe to the capital case because the next case is already waiting.